Well, a lot of you may be wondering what's really the purpose of owning gold in a portfolio? Well, research suggests that it's more than just riding a commodity bull cycle. Joining me today in studio, Ryan Giannotto, Director of Research over at GraniteShares. Ryan, good to have you on. First time on.
Yes. Thank you very much for having me. Been a very interesting time for gold.
Yeah, well, we've had your colleague Will Rind on, founder of GraniteShares, many times. So happy to get your perspective because you've done a lot of research on whether or not gold has become obsolete as a safe haven asset. One, what led you to do this research? And then two, I'll ask you what you've discovered.
Sure, yes. Well, I think there's a powerful dynamic, as we get into a more digital, more complex society, as tech finance becomes awfully technologized, we find a lot of investors pursue complexity for its own sake and forget about the basics. So have we moved beyond gold? And I think it's very safe to say, no, we have not.
Okay. So how did you do your research for this? Did you survey, a sample audience, or what's the background here?
Sure. So what we did was we looked at the data. We looked at the hard numbers. We stripped away the mythology of gold and looked at the asset itself like you would any other, asset or investment. And it's really a very compelling case of the power of zero correlation in this case. And it's a very compelling argument.
Tell me more about that. That's really interesting.
Yes. So when you start looking at assets, almost everything has something to do with something else in the world of finance.
Right.
And that's what correlation gets at. And when you look at gold, over the long term, the correlation to the market, or indeed any other economic force, is essentially zero.
How about US dollar, people would argue?
Well, yes, that's actually one of the few things it's negatively correlated to, and that's a powerful driver of returns and diversification. We all have dollar exposure. We don't think about hedging it. It's the exorbitant privilege of investing in US dollars that we don't have to worry about hedging against the dollar, but we all should.
So then, does it make sense that people use gold as a hedge?
Absolutely. I'd say there are three main reasons to use gold in a portfolio and why it's not obsolete. First is, to hedge against interest rates. The second is as a store of wealth. And third, is that it really helps moderate, diversify your investments. And those three together are very powerful.
So then what do you say? I just had a Bitcoin expert on before saying, well, gold it's over. It's been overtaken by Bitcoin, which is the new, I guess, safe haven despite its extreme volatility. What do you say to the Bitcoin
Well,
crowd?
I say, I consider gold the original fintech. In fact, the oldest artifact of gold we have goes back to ancient Bulgaria. It's a small bead, about 4 millimeters. And I consider that the Big Bang moment for, the modern economy, because it all started at that point, when we started, the financialization of human activity. And from there, now central banks hold over 30,000 tons of gold. It's become more important in our monetary system, even as we've embraced digitalization.
You've also, in your research, talked about improving the Sharpe ratio with gold, which is a metric investment managers look at, for risk and return. So tell us a bit about how we can apply this.
Exactly. So I would describe the Sharpe ratio as if I throw dollars out into the market, if I throw risk into the market, how much money am I coming back with at the end of the day?
Right.
And so what gold does is, it's really efficient at diversifying away equity returns, which are really powerful for long-term wealth accumulation. The problem is it's very volatile. Excellent instrument for returns, very volatile. And gold is efficient at moderating the extremes, the excesses of equity returns. And in fact, our research has indicated it's better than bonds at that task.
So Ryan, I'm sure you get this question a lot because I know I get it a lot. It's
Sure.
like, well, then how much gold should I have in my portfolio?
Yes. I mean, this is the staggering part. We looked at back to 2005 and started inserting gold into a 60-40 equity bond portfolio. And we have found the efficient level, the optimized level, was 35% gold. Not saying you should own 35% gold. That's an awfully high concentration.
Yeah,
but
a lot of people would say,
challenges
whoa, right.
the conventional wisdom of what pertains to gold and how we use it. Yes,
Well,
yeah.
well, because we usually hear 5 to 10%, right? That's
Exactly.
that concern. But you're saying it should or could
No,
go.
no, I'm not saying it should be.
Right,
Let's be
right.
clear, let's be clear. It just shows that in controlled circumstances, when we strictly are concerned about data, gold can be a very powerful part of the portfolio. You run into, I mean, obviously at 35%, you wouldn't want to put that much into any individual investment.
Right.
But from a strict mathematical, very academic perspective, very, I would say a highbrow ivory tower mentality, 35% is the optimized level.
And finally, Ryan, I guess, what do you make of the gold price right now? I know you can't give forecasts,
Sure.
but a lot of investors are frustrated that it's kind of taken a pause here. We've seen more positive economic data come out, less talk of recession that's perhaps hurt gold from its September highs. What do you make of what we're seeing here?
What I interpret this as is, gold has had an excellent run so far. In the past year, it's outperformed equities,
Right.
not year to date, but going back the past year. And so a number of factors have sort of, dampened its recent enthusiasm. We see trade, but, do we really think trade is over? Do we think the trade, talks are over? I'm very suspect on that. Also, we've gotten 3 cuts in the Fed, but, we see an asymmetry on expectations. There's still a possibility of further cuts, but not so much. No one's talking about hikes. So we see an asymmetry and risk there. But most importantly, again, this is the double standard gold faces as an investment. Bonds have fallen too. They've given back the ag has given about 7 months worth of coupons, but no one is flipping
Right.
out or getting excited
Right.
about the loss in bonds.
It's funny you mention that
Yes.
because I brought that up in a few interviews, in September actually, where I was like, does gold just get a tougher crowd in that sense that people expect so much from it that when it's like rising, we just want it to keep rising more than any other asset class, it seems.
Exactly, and I think this is one of the biggest problems investors make. They focus on price return
Right.
and not correlation. Investors may not want to buy gold in order to get rich. That's, the role of other assets. It's to constrain the risk of those get-rich assets.
Right, but
Yes.
that's an important point because do you feel that a lot of people are buying gold because they expect to make a fortune? And is that the wrong mindset then?
Well, we really want to take a holistic view to investment, and this is when gold really comes to its own, introducing independent sources of return that will zig when the market will zag. And that is, there are very few other assets that can really occupy that role.
Fascinating. Ryan, if we want to read more about your research or, where can we access this?
Yes. So that is at, GraniteShares.com. It's all available, and we put out, new content, every day.
Fantastic. Well, it was nice meeting you. And thank you
Yes,
so much
yes.
for coming in studio and
No,
braving the
absolutely.
cold, even though you say you love the cold.
I
so-
love the cold. I like to go against the trend.
All right. Well, you're stronger than I am. And I'm a Canadian, so thank you. Thank you,
No.
Ryan. And thank you for watching. We'll have much more for you on Kitco.com.